Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. As the week comes to an end, let's look at how new narratives have developed in the financial markets. We saw a bout of dollar weakness post the CPI numbers last week, which showed a decline in US inflation. This led to the markets believing that Fed won't hike rates post July. But the recent inflation figures, whether it be from Canada or the UK, have shown that inflation cooling is a phenomena experienced by them as well. Post this, we have seen some recovery in the dollar during the week. Morning, JK. It's been an interesting week. How do you see yesterday's US jobless claims data? Do you think the dollar might further extend its gains?
Good morning, Swaraj. Actually, last 24 hours, what I've seen is some divergent moves in the market. For instance, we had the dollar gaining steadily. The dollar index itself has been up around 0.8%. The much needed correction after a steep fall that we had seen post CPI numbers. But on the other hand, dollar fell against the Chinese yuan yesterday, and that was a reaction to consistent efforts from the Chinese central bank fixing the central rate at much lower than the market's neutral estimate. They did it today also. And yesterday, they eased rules for borrowing abroad for the companies, and also latest we have seen some measures to boost consumption of electronic goods. So there is steady effort from the central bank, not only towards the economy but also to boost the currency, because I don't think they're in alignment with the markets. One-way weakening of the yuan. So yuan has responded, falling from fresh attempt higher to now at 7.17 levels, and Asian currencies have also slightly moved up along with this. But the dollar itself has risen against the dollar yen 140 and the euro close to 1.11, which we were indicating as a correction. And the sterling had a very healthy correction based on the CPI data that came much lower than expected. A big relief for the British consumer as well as the government, which has been struggling to cope up with these price pressures. But the other divergent move that I saw was the Dow was up quite a bit, more than 1% at one point of time, and then nearly a 1%, and then Nasdaq ended actually 2% down, which is like hugely influenced by major tech stocks like Tesla down 9.74%, Netflix down 8.4%. In fact, Dow also eventually gave up its gain and closed only 0.5% higher. The Nasdaq has surged, almost 34% since April 22, and therefore this largest one-day fall since March 9 this year is not surprising. Market on the yields again. Yields were up, and these were not in consistency with the data that we saw. We had the jobless claims, of course, which came lower, but that should be read in the context of the fact that it might likely be revised higher in the coming month, because there are difficulties in adjusting the data for seasonal patterns. The automakers normally go for idle plants in July to retool themselves, and we might well see a higher number revised in the coming week. And then while existing home sales were down, then Philly Fed manufacturing index was down, prices paid were down, and then the conference board that publishes the leading economic indicators for US economy every month reiterated its forecast that the economy is likely to be in recession from the current third quarter to the first quarter of 2024. That's almost speaking about 3 quarters of recession for the US economy. And in fact, the leading economic index by the conference board has been in a decline for 15 months, the longest streak of consecutive decreases since 2007-8. And the fall is fueled by gloomier consumer expectations, weaker new orders, increased number of initial claims for unemployment, and a reduction in housing construction. So basically, they are considering a lot of forward-looking indicators that indicate how the economy is likely to be performing going forward. So when the yields were up, the 2-year as well as the 10-year, they have been up yesterday also, and That is surprising given the data that we have seen. There is a divergent in the views in the market as well about rates. July, of course, is almost a unanimous opinion that it will go up by 0.25%. There are some in the market who feel that September may still see a hike, and then almost a consensus that a rate cut will take much longer than expected. So these may be the drivers that could be behind the yields going up. As I said, the dollar rose the following the yields higher, and the biggest move was obviously seen in GBP, which has fallen more than 2.2% from the highs that it has seen. On the other news also, Japan, while the headline inflation announced today was lower than expected, the core reading, which excludes food energy, grew 4.2% in June, remaining close to the 40-year highs hit in the prior month. So the reading is an indicator of underlying inflation conditions in Japan, and it is closely watched by Bank of Japan in consideration for their monetary policy. And we have BOJ policy coming up next week along with the ECB. And the week following, we will see Bank of England also meeting once again. In yesterday, we had seen the rate hike by Turkey by 2.5% from 15 to 17.5, but it was below market's forecast of 20%, or rather 5% hike, whereas the other central banks are expected to either be on a pause or maybe going near the peak as far as the EMs are concerned. On the rupee, we had one of the narrowest ranges of 6 paisa during the day before. Just before the OTC market closed, we saw the nationalist banks withdraw their bids, and we saw rates falling to 81.92. That coincided with some strength in the yuan also. But again, based on the dollar index strength, we have seen the dollar rupee inch up slightly above 82, but nothing really very substantial to note about the rupee. We are still in that 90-20 range, and until something happens, this range is very much likely to hold as well. So just today, we don't have too much of data, except we'll see the UK retail sales figure to get a sense of their consumer behavior in the context of rising interest costs and record high inflation. Have a nice weekend. Thank you.
Thank you, JK. And I really like what you said about the divergent moves in the market, especially when it comes to the dollar, because we saw the US dollar gaining steadily, but falling against the Chinese yuan, because the central bank is trying to curb the depreciation which is happening. And also the economy is trying to, also the central bank and the government is trying to boost consumption of electronic goods in a measure to improve the overall economic picture of the country. We saw, of course, in the equities, Nasdaq falling by nearly 2%, driven by fall in large tech stocks like Tesla, which fell nearly 9%. And we are also observing an increasing expectation of US going into a recession in the further quarters. While market participants remain divergent on the September rate hike expectations. In Japan today, we saw the core inflation, which grew to 4.2%, which is quite significant. And of course, the next week we have the BOJ and ECB meetings. Nothing new to write home about rupee, because it traded in a narrow range of 6 paisa yesterday. And it continues to hold the broader range of 81.90 and 82.20, as JK mentioned. That's it from us today. Have a very good weekend. Thank you so much for listening.